Hi, my name is John Palmer, Senior Vice President and Head of Real Estate Investment Strategies for Westwood. I wanted to take a couple minutes to share my thoughts on the REIT market for the month of May, but as usual, I'll preface my REIT industry comments with some observations about the macro. May proved to be another fairly strong month for equity markets as the S&P 500 index finished up 5.3% for the month, and the Nasdaq did even better at up 8.4% for May. Credit was relatively muted for the month of May, with investment grade credit producing a positive return of 48 basis points, and high yield came in around 31 basis points positive. Spreads remain near the tighter end of their 5-year ranges. We'll go deeper into the REIT performance a little later in the video. The equity market's performance this month continued to be shaped by the ongoing US-Iran conflict, which has now stretched into its 4th month, and the Strait of Hormuz effectively remains shut down. Oil prices remain volatile, and nationally, gas at the pump sits at $4.32 a gallon. These elevated energy prices continue to put pressure on consumer confidence. Despite the geopolitical uncertainty, markets held up as the Q1 earnings season wrapped up with generally strong results. Of note, AI-related capital expenditure plans from the hyperscalers remain a notable tailwind, with several major players reaffirming or raising their spending guidance for the remainder of the year. Switching to the economic side, the big data point of the month was the inflation report, which showed that the U.S. annual inflation rate stood at 3.8% for the 12 months ended in April 2026, up from 3.3% in March. Excluding the volatile food and energy sectors, core consumer prices rose 2.8% year over year, and consumer prices rose 0.6% over the course of the month. Regarding the labor market, the most recent jobs report indicated that the U.S. economy added a surprisingly resilient 115,000 non-farm jobs in April, comfortably exceeding economists' forecasts, while the unemployment rate held steady at 4.3%. While the labor market is not breaking down, it's clear that the lagged impact of elevated energy prices and tighter financial conditions in certain pockets of the economy bears watching. Switching to the monetary policy front, while the Fed did not meet in May, Kevin Warsh was officially approved by the Senate on May 13th to take over as Fed chairman from Jerome Powell. The Fed funds rate currently sits at 3.5 to 3.75%, and futures markets are now pricing in one hike over the next 12 months. It'll be very interesting to see what policy levers Chairman Warsh can pull given the state of the macroeconomy and the uncertainty on the geopolitical front. So with that macro commentary behind us, let's move specifically to real estate. On the first slide, we show the 10-year Treasury chart since the beginning of the year. The 10-year started 2026 at 4.17% and ended May at 4.44%. So we've seen 27 basis points of yield increase since the beginning of the year. From the February 27th low of 3.94%, the move is 50 basis points, reflecting the continued repricing of inflation risk into longer-term rates. Switching to REITs, on the next chart, you'll see the May performance for the MSCI US REIT Index. The RMZ posted a slightly negative return of negative 20 basis points for May, but REITs remain up 14.1% for the year. Next, I thought it would be helpful to put the May REIT performance in context with the broader market. On the following chart, I've broken out the S&P 500 index into its 11 GIC sectors. As you can see, REITs in the S&P 500 index ranked 7th with a total return of negative 1%. On the next chart, we highlight the May REIT performance by property sector. Leading the pack were lodging, office, specialty, and shopping center REITs, whereas mortgage REITs, both resi and commercial, net lease, and manufactured housing lagged for the month. Lastly, I thought it would be helpful to show the change in valuations from the beginning of the year. As you can see on this last slide, implied cap rates have tightened a bit pretty much across the board during the month of May. This had less to do with price appreciation and more with the street bringing up forecasted NOI for the full calendar year following the Q1 earnings season. Right now, the overall implied cap rate for the REIT market currently sits in the low to mid sixes, which is approaching the long-term historical average for cap rates. As always, I thank you for your time, and if you have any further questions, please feel free to reach out to Westwood directly. I look forward to sharing additional updates with you in the future.